Hello and welcome to today's webinar. My name is Jacqueline Dorsey of Lean Frontiers and I'll serve as your host today. I'm excited to bring to you today a short webinar on lean accounting facilitated by Brian Maskell. So for now, let me turn things over to Brian.
Okay, good morning everybody. So this is just a short webinar and I'm really just going to focus in on 5 ways to make more money from lean. And what I'm interested in is just kind of giving you some tools that you would be able to use that would be helpful to you to maximize the profits and revenues of your lean as you make lean improvement. So let's get going here. Making much more money with lean. Well, to do this, we've got to understand what the economics of lean is. And lean's not about cost cutting, is it? It's about growth. You know, if you think about this, when you do lean, you eliminate a lot of waste. Now, what happens when you eliminate waste? You save money. Well, yeah, you some. You know, maybe you do some improvement and you improve the quality of the product or something. Then maybe the cost of scrap and materials will go down. But mostly, cost does not go away because you've still got the same building, you've still got the same equipment, you've still got the same people, everything. Not much has changed. So what has really happened? What's really happened is we've eliminated waste and we've created available capacity. Now, the economics of lean then is to say eliminate waste, free up capacity, then you can design, make, and sell more product, which means that you can then grow the business. Now, let's suppose then right now you make and sell, pick a number, 100 a week or something. As a result of lean, maybe you can make 120. Now, what would be the cost of that additional 120 if you've freed up that capacity? The answer is nothing, isn't it? Just the material cost. And that's the economics of lean. And that means when you're doing value stream mapping and things like that and deciding what your improvements should be, who should be involved in that? Well, it's got to be the sales and marketing people and product development, the people that are going to fill that additional capacity and build the growth. You know, it's amazing to me. I've worked with lots of companies, and when they do things like value stream mapping, you find a whole bunch of engineers from the shop floor and shop floor people, and that's good, of course. That's important. Those people should be there and understand that. But got to recognize if we're going to grow the business, we've got to include the people who have the ability to do that growing. And the job then of sales and marketing and product development is to harness the capacity that we're building into our business and creating month after month, year after year, so as to maximize the financial benefit for the company. So let's look at these 5 ways that we're going to look at. I've had a little bit trouble getting it down to 5, but we only have half an hour, so these are the ones I picked. Now, the thing to recognize is that lean is a very different way of running the business, and the traditional financials just don't work. Not because they're bad, but they're designed for something quite different from lean. And so the first thing we're going to look at is timely information that everybody can immediately understand and use. So timely, we need it quickly, and we need something that everybody in the business can immediately understand. Number 2 is better information that leads to better decisions, that leads to more revenues and more cash. We've got to focus on those things so we can grow the business and prosper ourselves. Number 3 then is to have the right measurements. We need to have measurements that motivate everybody in the organization for continuous improvement, whether that's on the shop floor or whether it's in the accounting office or in sales and marketing or product development or administration. We've got to have measurements that motivate people for continuous improvement. The traditional measurements that companies use are the opposite of that. They are actively pushing back against lean. For example, if you measure the efficiency of the people in production, that will actively undermine what you're trying to do with lean. So number 4 then is to correctly calculate the financial benefit of lean improvement. Now there's several different kinds of benefit when you do lean improvement, but I want to show you a good method of how to calculate the financial benefits. I was working with a company just about a month ago, I guess, and they had a way to calculate the financial benefits. And what they said was that what we do, so yeah, they gave me an example. They said, here's a Kaizen event, and we've eliminated 2 minutes out of 10 minutes in the production process of an item. So instead of it taking 10 minutes, it now takes 8 minutes. Then they make 1,000, I don't remember the number, let's say they make 1,000 a week. So that means that we're going to save 2,000 minutes a week. We know what the cost of labor is and we know what the overheads are. Multiply that together, then that would tell us for those 2 minutes for each item and the 1,000 that we make, that's what our saving is, or not, they didn't say saving, that's our cost reduction as a result of lean. Now, that's the kind of thing that would make accountants very excited, isn't it? We're going to save that sort of money week in and week out, month in and month out. But of course, none of that goes to the shop, goes to the bottom line. Because we've still got the same equipment, we've still got the same people, we've still got the same fact. You know, nothing has really changed. We've got to be able to understand the true, actual bottom line in the bank changes that are going to happen as a result of lean. Number 5, then, I just want to show the lean accounting and these lean approaches to the way that we do these things are just a lot less work. It's always a little hard to estimate how much, but it's somewhere between 20 and 40 or 50% of the time of the accountants goes away. But also a lot less work for the people on the shop floor, a lot less work for the managers and those kinds of people. So those are the 5 things I want to focus on in the next half hour, or next 25 minutes. So I've got 5 minutes on each one. So timely reports that everybody can immediately understand. You know, we need to control our processes better, and to do that, we've got to have frequent reporting. Also, if we want to really control something, we don't really want to control it by a financial report that comes out a month later. We've got to control it in a much better way. Also, if we have financial information, we've got to have financial information that people can immediately understand. So that's what we're looking for. Traditional reports come out too late, usually month end or beyond, and they're too complicated. Nobody understands them, or very few people in the company understand them. You think about it, think of your company. How many people understand what overhead absorption is? I bet you could count on one hand the number of people who could actually explain what it is, let alone why it's there. And yet, that drives really anti-lean behaviors, doesn't it? What do you do if you haven't absorbed enough overhead by the 3rd week of the month or something like that? You just build a lot of inventory. You overproduce. The absolute opposite of what we're trying to do with lean. Similarly, if you calculate standard costs and make decisions with that, that's going to give the wrong decisions, leading you in the wrong direction. Now, why do we need something frequently? Because we need to be able to react more quickly to the issues. We've got to be really on the ball and on time with the information that we're getting. Also, we've got to control our costs better. We can't control something that where the information isn't coming very frequently. But if we do have information that comes frequently and with information that people understand, that leads to people being able to immediately come to the solutions. Now, what is frequently? Well, typically, we would want to do financial reporting on a weekly basis rather than monthly. Now, we have some of our customers do it every day, some do it every 2 weeks, but you've got to pick what is the appropriate frequency for reporting of financial information. And then we've got to report it in a very simple and straightforward way. See, most companies, because their information comes out late and is too complicated, it's kind of like driving with a rear view mirror. That's what this little diagram is down the bottom. And what we're looking for really is to do something that's going to be forward thinking for us. So we can look ahead, plan the future, and make changes that are needed at the right time. So that's the first one. Timely financial reports that everybody can immediately understand. So let's look at the immediately understanding here. This is a simple example of a traditional income statement. Now look at this. We've got revenue at the top. Period 1, period 2, about 2 million a month. Then we've got this cost of goods sold. Now what is that? Well, that's the cost of the products that you sold if everything had gone exactly on standard time and standard costs. The gross profit then is the revenue minus that, which gives us the gross profit here, $380,000. Now, what does this mean? I've used this little example many times with a lot of people, and no one has been able to tell me what it means. They can define it. They could say, well, that's the profit we would have made if our products had been made at standard. But they never are they? That's what the adjustments are below here. Now I've only put 4 variance adjustments here: purchase price variance and material variance and labor variance, overhead absorption variance. But these are the variances against the standards. Now, what can you do with these numbers? Most people have no idea what they mean, and how can you actually use these to improve the process, make it more lean? In fact, even these variances will push back against what we're trying to do with lean. And then we've got a bottom line profit here. You can see period 1 we made 197,000. Period 2 we only made 99. Why? Look, the revenues are about the same, aren't they? So why are they different? Now, some of you will be cost accountants and management accountants and people like that. You would be able to go in and deconstruct these numbers and come up with that. But what we recommend is what we call a plain English income statement. Now, the revenues are the same because those are real, aren't they? We actually sold $2 million this month. And then we just list what are all the costs. Now, a real one would have more lines than this and more detail, and you'd be focusing in on on certain issues. But this would give us then the total cost, which would then give us the gross profit. Now, this gross profit is real. This is the revenue minus the costs that month. The revenue this month minus the costs that month. That 299,000. That's how much money is going in the bank. Now, if we ask the question, well, why is the bottom line profit different? Well, you can see there's been a huge inventory adjustment. I made these numbers up. This is not real, and I made this very big just to emphasize this. But you can immediately see what the issue is. Inventory adjustment has made a significant impact on the net profit. By the way, that's another thing most people in your company don't understand. If you say to them, oh, we're building a whole lot of inventory because that's going to make our profit go up. We didn't make another sale, but we built a whole lot of inventory. Who can understand that? And yet that's what companies do. Many companies anyway, hopefully not many of yours, but many companies will do all kinds of stuff at month end and quarter end to just build up inventory and build up absorption. Plain English income statement. And I hope if you look at this that you would say, well, yeah, this is something that pretty much I could put in front of anybody in the company and they would understand it. It's not really a lot different from a home budget. It's what are we bringing in, what are we selling, and how much do we have left over? That's what we want, something that's clear, understandable to everybody. And then we want it frequently. As I said, typically weekly is what we'd be looking for. So that's number 1. Better information. Number 2, if we have better information, we can make better decisions. If we have better decisions, we can have better revenues and cash. So that's what we want. We want to make decisions based on real bottom line cost, bottom line profit, bottom line cash, real stuff. And then we want to have standard methods, and we use a tool called a box score, which some of you may be familiar with. But so we want to make the decision with real numbers, not like standard costs and things which are sort of made up and with a whole lot of allocations and a lot of strange numbers. We want to use something real. How much money is going to go in the bank as a result of the different approaches that we can take, and so when we're making a decision. So if we do that, we want to get better decisions. We want to be able to do a whole bunch of what ifs, and also we want to make sure that what we're measuring is the true financial impact. No confusing things like allocations and overheads and absorptions and standard costs. No distorted information. We want to make it clear-cut and simple. So let's give you an example here. we've got a company that receives a request for quote from a customer, and they want to buy 3,000 Pro Valve 602s. This is actually a real company, although I've simplified some of the numbers, and they make valves. Mostly, I think they have more than 100,000 different valves that they make. The customer's target price is $45, and the company requires a minimum of a 15% margin against their standard cost. Should we take the order? Well, let's look at the numbers here. The price is $45. The standard cost for this item is $42.34. Should we take the order? No. It's nothing like the 15% minimum margin. So the sales guy's about to pick up the phone and tell the customer to get lost, when the purchasing guy says, wait a minute, this is a big enough order, 3,000 a month, for us to maybe source this from a low-cost country or something like that. Let's investigate that. So sure enough, the procurement guy, he's found a Far East supplier that they can buy from a landed cost of $33. So let's take a look at that now then. Our price is still $45. Our outsourced cost is $33. Now this company recognizes that there are additional costs associated with buying from low-cost countries, so they add 7.5% additional overhead cost to take account of that. So our total material cost then comes to $35.48. Profit now is $9.53. Margin is $21. So should they take the order? Absolutely yes. This is way above the 15%, or a good deal above the 15% minimum. This is good business. So the purchasing guy is about to pick up the phone, and he's going to order a boatload of these Pro Valves that is going to take account of the customer's need for the next year. When I say a boatload, I actually mean a boatload that's going to turn up on this. When the value stream manager in the area that makes these kinds of products, he's saying, well, not so fast. Let's take a look at what would we have to do in the value stream to be able to do this. So now we're going to look at this a little differently. If we make it in-house, they got to hire a couple more people, they got to buy a couple more machines. What does that look like? Well, now we're going to look at it like that. We're going to say, well, what is the performance of the value stream now? These are the typical revenues, monthly revenues, I guess, and then here are the various costs. And again, in real life, you'd have a longer list of costs here, but these are the major ones here. We've got material, labor, and machines, and then other stuff. And that's the current profit they're getting, and this is the return. Now, if we include the new product, the new sale that we're looking at, the revenues would go up by 130,000. But the material, of course, we've got to buy, but we've also got to hire more people and more machine costs and so on. If we add that across, this is what it would look like if we decided to go that way. So now our revenues would go up, of course, our material costs would go up, labor and machine costs would go up. For the sake of this example, our other costs would stay pretty much the same, and our profit would go to 312. So what's the right way to make a decision here? Well, let's compare those three. If we looked at the three, if we did this by standard cost, well, nothing would change because we would just we wouldn't take the order and we'd hand that order over to a competitor. If we go with a low-cost country, yeah, we can make more money on that, and that would be better. It would be an improvement, not huge, but it would be better. And then but if we make it in-house, that's actually in this case the best way to go. Now, of course, the best way to go might have been a different one, might have been the low-cost country way, but in this case, the best one here is to make it in-house. So what are we doing here with the decision? We're not looking at the individual product and the individual price. What we're looking at is we're looking at the value stream, the overall system, and what we're saying is what is the impact of these changes on the value stream as a whole? And that's the way that we mostly approach decision making in a lean environment. I'd normally say, does that make sense to you? But of course I won't be able to hear your answers, so I'll just move on here. So number 3 then, measurements. uh, we need to have measurements that drive lean improvement. Now, when you drive lean improvement, what do? You bring your batch size down, you go to single piece flow, you reduce your inventory, you go to pull, you develop cells that flow together and things like that. Now, those are all good things and they're going to give you good results. But would the traditional accounting show that good things have happened? 9 times out of 10, the answer is no, because you'd be measuring operationally things like efficiency. So we know what the standard time it is to make this, how much time does it actually take now, and that would have to take account of changeovers and all these other things. And so is it taking us more time or less time? That's the efficiency of the people and maybe of the machines as well. Another thing we'd be looking at is absorption as well, and profit. Now, if you just look at these with the traditional accounting, this is going to show that your efficiency gets bad, your absorption gets bad, and the profit goes down. Now, why is that? That's because the traditional accounting is designed for the sort of mass production that was done in the 1920s and even the 1950s and so on. It's not that the accounting is bad, it's that it's not designed for what we're trying to do with lean. So if you're using traditional accounting and traditional accounting measures, like absorption and efficiency and things like that, then your accounting system will actively be undermining what we're trying to do with lean. So what we need to do is to get good lean measures, good lean financials, and then make sure that the way they work motivate people to do things that are lean. The other thing is important too. We've got to be able to see the lean. See, if you do the traditional accounting, then that's going to show that things are getting worse. We've got to have accounting and measurement systems that show whether good things are happening from a lean point of view. Well, from any point of view, but certainly it's got to show how the lean works. So, sorry, I jumped too far ahead. So that's number 3. We want the right measurements that motivate the right behaviors, and for that we've got to have lean measurements and lean financials, and so that people can really see and understand the things that the outcome of what they're doing with lean. Now let's look then at the financial benefit. So we're planning to do a Kaizen or some other kind of change or a series of Kaizens. We're going to try and estimate, well, how's that going to improve from an operational point of view? How much waste can we take out, and how can we use that waste, and what are we going to do with that? We also want to know, well, what's the financial impact of that? So how does it affect us operationally? How does it affect the capacity within the organization? And how does it affect us from a financial point of view? Now, it's not easy with traditional accounting to actually work that out. And I gave you a rather silly example just a few minutes ago, didn't we, of how some companies work this out. I'm sure your companies have other ways to do it. In fact, you can use the traditional and find out ways to give you the real numbers, but it's outside of the financial system. You have to go off and do it differently to do that. But what do we want to do? If we're going to do a Kaizen event or a series of improvements over the 3 months or 6 months or something, current state, future state, that's a whole lot of work, isn't it? We're doing a 5-day Kaizen event and all the prep work you have to do ahead and all the things you have to do after that to make sure it's sustaining. That's a lot of work. We want to maximize the benefit to the customer, maximize the benefit to the operations, and maximize it financially. And we've got to be able to see that coming up on the financial reports. We also got to have some attention to value, isn't it? Customer value is the first principle of lean. We've got to be able to see that. And also, we've got to have this attention to growth, because that's the economics of lean is deeply involved with these kinds of improvements. So how do we do this then? Well, we've got to understand the financial benefit at the true bottom line increase in profits and cash. And the bottom line increase means how much money is going to go into the bank as a result of what we're doing. So we've got our current state map, we've got our future state map. And then we would put together this box score. Now, some of you are using these or have seen them before, but I'll just explain what a box score is. This three pieces there. The first piece is the operational performance measurements. So this is for the value stream. So we've got, what is it, 5 or 6 key measurements for the value stream, the operational measurements that tell us the operational performance of the value stream. Down the bottom, we've got a summary of the financials. What are our revenues? And then what do we spend on the key things? Materials, labor, machine costs, other things. So this is a summary, and it shows the profit and the return on revenues, and we can compare that. Right now, you can see it's 17% return, but we've got a requirement, a hurdle rate of 28%. So we're way down here, but the box score would show that information. And then the third one here is dealing with the capacity, your people's time and your machine time. So here we're looking and saying, how much of our people's time is spent doing things that we consider productive, which really means making product. In this case, 69%. How much of their time is spent doing things that are important to do but are not productive? Things like changeover and things like scrap and also things like 5S and those kinds of things. Things that have to be done but are not productive things. In this case, 32%. So our available capacity here is -1. So we're using up all our time and a bit more as well. So that's the box score: operational measurements, capacity information, and financials. So now we're going to show several ways to use this box score, but now we're going to look at how do we use this to for financial benefits, and the box score becomes standard work for showing the performance of the value stream. We don't want to have a whole lot of other reports. I was at a company, one I'm working with quite regularly now, but when I first went there, which is last November, I asked them about their financial and operational reports. They showed me 92 reports that they produce every month, and this is just in the one factory. We've got to have standard work for our reporting, and it's got to be powerful, simple, lean focused, all of the things that we're looking for. So look, how do we get this true financial benefit? Well, this is a good question. How much money are we saving? That's a good question. But there's a better question. A better question is this: what are we going to do with that freed up capacity? Because that's what the economics of lean is, isn't it? Of course we're interested in saving. That's really important. What costs can we reduce and eliminate as a result of improvement? But what's more important is, what are we going to do to use the capacity we're freeing up by eliminating a whole lot of waste? And so that's what we're going to look at. So here's that same box score. You can see the current state there. And now in the centerpiece, we've got planned improvement. So maybe over the next 3 months, we're going to do 3 Kaizen events to get us from our current state to our future state. And here are the estimates of the changes that will occur as a result of those 3 Kaizen events. If you add those across, this is what the future state is going to look like. So after we've done these 3 Kaizen events at the end of 3 months or 6 months or whatever the time frame is, this is what we expect the box score to look like. Now you can see, I won't beat this to death, but you can see that the operational numbers are going to be really good. Most of those are improving. Productivity doesn't, because the revenue is not going to go up and the number of people in the value stream is going to be the same. But the others are improving really quite well. Jump down to the financials. Well, yeah, we're going to make a bit more money, but it's not stellar, is it? We're going to go from $242,000 a month, I guess, that revenue profit rather, to 267. So that's $20,000. That's good, but it's not really very breakthrough. So what's really happened? Operational numbers have gone up really well. Financial information is going up, but it's kind of wimpy. Well, you can see here, can't you? What we've done is we've freed up a bunch of capacity. So what is the question? What are we going to do with that capacity? Excuse me. Well, one of the things we can do, of course, is move people out of the value stream. Now, of course, it's the lean company, so when you move people out, you don't move them out of the company. You just move them out that value stream and you find somewhere else where they can be adding value. Now, if we did that, then the profit's going to go up. We're going to go from 242 in the current state up to 280 85, and that's going to take us then from a 17% return up to a 20%. That's good improvement, better than we had before. The second one is we can introduce new products. Now, the real company that this is based from, they had already been working on a whole lot of new products, and they've done a great deal of voice of the customer and really understanding what do we have to do to create value and all the things that you do with lean product development. And they had a bunch of new products pretty much ready to go. Now, they did pulled a lot forward and things like that to match it to when the capacity was going to become available. And so there, they introduced those new products, and you can see that's an astonishing profit improvement, isn't it? It's going from 242 in the current state up to 489. Now, most companies don't achieve that kind of stunning improvement every time they do a lean improvement, of course, but these were new products coming in at higher prices and, in fact, lower costs. And so that's what drove huge improvement, and that actually takes their returns from 17% to 29%, which exceeds the hurdle rate goal of 28% that they've got. So, so that's another thing they can do. Now, if you can't do that sort of thing, what else can we do? We can maybe insource some stuff that we've done that we're currently outsourcing, and again, that would give us some improvement. And I've only put 3 here because that's all the space on the slide, but when you do this in real life, you come up with 15 or 20 different scenarios and combinations of these different issues, and then you put these onto this box score, and then you can make a good decision about how we're going to maximize the benefit from the lean improvements that we're making. And again, sorry to sound like a broken record and saying the same thing over and over, but this additional profit is real. This is how much more money is going to go in the bank, not some kind of fictitious margin or anything like that. This is really how much money is going to go into the bank. And therefore, with this information, we can make good decisions. Now, there might be all kinds of other business issues that we want to take account of, but these are real numbers that that you can use when making these decisions. So that's how we look at what are the financial benefits. We look at what's really going to happen and how does it impact the value stream as a whole. Number 5 then. Lean accounting is a lot less work. See, all the reporting we do, let's look at it from the accounting, the financial piece. We're producing income statements on a more frequent basis. You could say, well, that's more work, isn't it? Well, yes, it is. But the actual gathering of the information is much simpler because we're reporting at the value stream level. We're not reporting at individual work areas or individual products. There's a whole lot less transactions or fewer transactions that we have to use. In many cases, millions of transactions. We did work with Boeing some years ago, and they eliminated 3 trillion transactions from their processing, and that was just one of their aircraft groups. And so that's what we can do, because when the lean accounting methods are much simpler and they're at a value stream level, and that means just thousands and thousands of fewer transactions, just a lot less of that complicated work, because every transaction leads to a report. Every report leads to a reconciliation. That leads to a meeting, and then the meetings turn into other meetings and all kinds of just terribly wasteful stuff. We don't need variance reports. We don't need complicated allocations. We do need visual management. We do need to improve our operations and our financial control. And so what we're trying to do with lean approaches to the financial reporting is we want to get better information with better control, but with a lot less work. One of our customers that, in fact, I wrote a blog on this if you're interested in more detail, and it names the customer and gives you a lot of information, but the controller there, it's a large company, but this particular plant has a controller and then a couple of other people, but the controller is the main financial person, and it freed up 20 or 30% of his time, and he's now certified as a as a lean person. So he's now not only doing his real work, but also doing very actively involved in lean of all kinds in the plant. He's also got very much involved in strategic purchasing as well. You know, finding suppliers who are close by so that they can come up with frequent deliveries of smaller quantities and negotiating prices and things like that. And this is exactly what we want to do, because what we're doing then is we're eliminating waste. Now in this case, we've also eliminated waste in the controller's time. He's got 20 or 30% time freed up. We've eliminated waste and freed up his capacity. And now he can then use his time to do things that are strategic and important and driving the company forwards. Instead of spending his whole time doing bookkeeping and reporting, and of course that's important, but now as a result of lean, that's freed up enough time for him to be working on things that are strategic. Okay, I've got to wrap this thing up. So lean accounting frees up people's time. It also enables us to make decisions at the lower level, because the information is simple and we have standard work with our box score. So that's it. 5 ways to make more money with lean. You know, traditional accounting doesn't work. Lean accounting gives you, or lean accounting methods give you great benefit, and it's not a one-time gain. This is something that happens year after year after year. Eliminate waste, free up capacity, design, make, and sell more products. Free up the people's time so that they can then use their time in ways that are much more strategic. Okay, I'm going to skip over this last example because I've taken a little more time than I expected to. But making much more money with lean. We can make good decisions, better decisions. If we make good decisions and better decisions, we wind up with a whole lot of revenues, profits, and cash. All routine decision making is done with this box score, and this happens over and over in the organization. And you get real operational capacity and financial information. You get better information, you can do what-if analysis, and it becomes the standard work for the way you do your business. So that's the economics of lean. And thank you for listening, and it's good to speak with you. Now, if you want to get in touch with me, I'm sure we've got some, oops, sorry. If you want to get in touch with me, you can get in touch with us down here at maskell.com. Here's my email address. When I say get in touch with me, if you've got questions on this, just let me know and I'll answer your questions. So thank you for your time, and it's been a good session. Thank you.
Brian, thank you for facilitating our session today. As mentioned previously, today's webinar is being recorded, so look for an email following our time together for a link to the recording. Feel free to share this throughout your organization. So again, thank you, Brian, and thanks to each of you for participating in today's session. Goodbye.